All right, everyone, we're going to get started tonight. First off, I'd like to welcome you all to our Invest in Your Future webinar about planning in retirement for investments. Thank you for joining us this evening, and my name is Zach Egger. I'm a Business Development Officer here at L.P and if you're joining us tonight because you want to know about how you can retire and what your retirement options are, then you're in the right spot. Our goal tonight is to give you an overview of planning for retirement, what investments you should use, how much is enough, and other factors you may need to think about when you are about to plan for your retirement. Before we get started, I'd like to mention that this session is a live webinar, and a recording of the webinar will be sent out shortly soon after. You will be in listen-only mode, but our presenter will have a dedicated time to answer your questions towards the end of the presentation, and we encourage you to ask them along the way by typing into the question box below. If you're on a regular desktop, there's a Q&A section towards the bottom right corner on your screen. If you're on a mobile device, you can click on the 3-button ellipsis on the bottom screen to get to the Q&A. Please type in your questions. We will make sure that we can get to as many as we can. So I'd like to introduce our speaker today, Patrick Infante, our in-branch financial advisor and planner with CUSO Financial Services. Patrick is going on his second year with L.P and prior to joining us, he worked as a senior financial advisor at Wells Fargo Private Bank in Beverly Hills for just under 10 years. He also spent his earlier years at Ameritrade, E-Trade, and UBS, among other firms. He holds several security licenses and is also a life insurance specialist agent. And without further delay, I'll turn it over to Patrick.
Thank you, everyone. Thank you, Zach. Thank you, everyone, for joining us tonight. Thanks for taking time out of your busy schedules. We appreciate you, joining us and being able to share here with you some things about, planning for retirement. So, as Zach mentioned, I'm a financial advisor, a financial planner. I've been in the business over 26 years. I have worked at various firms, both on discount, full service, and can really help overall. Our goal tonight is just to help you, gain some interest and some knowledge about overall planning, from early stages on through the middle years in life, into retirement, understanding, what choices you have to make, how to plan, what some of the headwinds will be. We're going to cover a lot. Our goal is just to help you, get some interest and spark, something that's going to say, hey, let me check in and see where I'm at, and help you really get geared up to plan correctly into your future as we move forward. So we have a lot to cover tonight. We're going to jump into the slides, and some of the objectives we covered tonight: planning for retirement, starting your career, of course, when you first start working, right, early on. We're going to go over growing your net worth as we were working and saving money up, right, building assets. Then we're going to go discussing when to retire, right? That'll be different from everyone. That's a question that comes up a lot. Then we're going to go over drop options as well. Then we're going to discuss choosing investments. What investments are out there? What might be the best for your specific situation? How much is enough comes up a lot, right? How much is enough to retire? Then we're going to talk about distribution amounts into retirement, sequence of returns, recession and depression, which are some of the headwinds that we may face, that historically in the markets as we're investing. The next slide, some of the other objectives we're going to cover is inflation, which has been in the news quite a bit, of course, a lot of inflation going on right now. We'll talk about how inflation affects bonds, stocks, alternatives. We'll also be talking about annuities, insurance, life insurance, and sticking to a plan, right? Creating a plan, sticking to it, and knowing that, hey, historically, if I stick to my plan, it'll work out. And then the next steps as well, okay? So as we start off here, our first slide goes into starting your career. Okay, when we start our career, we start working, we get a good job. The first thing we always want to do is create a budget, right? We want to see how much money we're taking in, net income after taxes, right? And how much expenses we have, right? Early on, it'll be rent, might be car payments, insurance, right? Food, all your essentials. So the budget's the first thing we got to start from the ground up. Our income, right, and our expenses. To see how we want to budget. We want to be budgeting every month. We want to make sure we have enough for our bills. We're comfortable. And then from there, how much can we save? Do we have a little excess, right, to save? So ideally, we want to be able to put a little bit of money away and start saving. And then we're going to discuss what type of accounts we would use for different, goals, whether it's short-term goals, longer-term goals. As we're saving, where do we want to save certain amounts of money? What's the best avenue to put money into? Okay. The next slide we're going to jump into here is going to be setting up the accounts. Okay. The first thing we want to discuss really before we really talk about retirement planning, et cetera, is the emergency fund. We want to always have an emergency fund set aside. That'll be money you can get your hands on if something unforeseen happens, right? You want to have that safety net there. Could be, let's say, a car breaks down, could be an appliance breaks down, like a refrigerator, that can cost $1,000, $2,000, $3,000. Anything that's unforeseen. Maybe you can't work for a number of months, right? Maybe you got sick, maybe you have an injury. So typically, if you're a sole earner, you want to have ideally 6 months of reserves. 6 months of income, net income for your emergency fund. Again, to cover all your essential bills, your rent, car, etc. So you want to have that cushion there. 6 months is ideal. If you can save up and have that amount in your emergency fund, that's a great amount for a single person. And that can be sitting in a liquid savings account that gives you some interest, something that's going to give you access to the money should you need it. If you're a dual household and you have two incomes, you can typically get by on 3 months. So 3 months of an emergency fund would be good for a couple, two earners. That way, if one of you, again, is not working or can't go to work temporarily, you have that emergency fund of 3 months, plus the other person's still working, right? So you can get by for that short time period. It might be a different situation. Maybe you get laid off. Maybe there's downsizing, right? So especially if you're a single earner, you got to get back on your feet again. You want to have, again, ideally 6 months for one person, 3 for a couple, to make sure you have that emergency fund set aside. That's going to be always the first thing we want to look at. After that, we want to start identifying goals, right? The goals would be short-term goals, mid-term goals, and longer-term goals. Some of the goals we would look at would be car, okay? Of course, we want to, get a car. Maybe we're going to be making payments, financing a car. You're going to be including the insurance, of course, for that bucket. Then we want to look at home, right? Initially, we'll be probably renting, right? And then later on, we want to start having a goal to buy a home, so start saving towards a home. We might have some college costs, right? Through later years, as we're getting, older, we might be still doing some education. It might be a college cost for our kids or grandkids. And then, of course, the goal of retirement. How much for retirement? What's that goal going to look like? What's retirement going to look like for everyone individually, right? So we're going to discuss all these individual goals. And then on the right here, we're going to have account types, checking and savings, IRAs, Roth, and we go into these on the next slide. So I'll go skip to the next slide. We'll go into more detail on the accounts we would be using. So again, checking and savings. As you know, these are liquid accounts used for short-term goals. Checking and savings, money you can get your hands on. We have several types of different checking and savings accounts here in the credit union. I'd refer you to my team members for these to discuss what the pros and cons are, see which account might be the best for your specific needs. We have several, and again, the team members can discuss these with you. Then we go into IRA. The IRA is going to be your individual retirement account. Okay, this is where you start putting money away for retirement. Individual retirement account, typically if you don't have a company-sponsored plan, you want to set up that solo individual retirement account where you put money in every year, ideally. And you want to start early, right? When you start working in your 20s, whatever age that is, set that IRA up and start putting money. The current contribution is $6,500 a year. So you can put that in every year. You can deduct that off your income, so it helps you on what you report of your income. But the main thing, you're putting that money away towards retirement. And that, as the years go by, it'll start compounding and it'll be growing into a nice amount later in years. The next one here is a 401k. These are tax codes, by the way. A 401k means that you work for a for-profit organization. The 401k is a company-sponsored plan. And on these, you can put up to $22,500 in per year. The limit went up from about $20,000 last year. So these are great because then you can put a bigger amount in. Also, a lot of employers will match. So if you're putting 5-8%, an employer might match dollar for dollar, or they might just put a certain percentage in. On the contributions, the more you can put in, the better. If you can put in 5, okay, 8, 10, that's not bad. So you want to kind of adjust it. If you make a contribution to the 401k, you can adjust it, right? If you say, oh, I'm putting too much, my budget's too tight, you can scale it back. 10 is a good number, 15 is even better, right? 15%. It's really going to help build that money up. And again, it's going to bring your income down as well because that's going pre-tax, okay? The 457, same thing. The 457, you work for a government agency or a government entity. Also, you're putting money in there pre-tax, and it's going to, tax deferred, right? Tax deferred into retirement. The 403B, very similar. Again, this would be for nonprofits, could be teachers, healthcare, same kind of idea. You're putting money in pre-tax. These last two also have the contribution limit of 22,500 currently. That may go up. It's been going up pretty steadily. So again, you put money into these. Again, you might get a match from your employer, which is nice. And even if not, you want to continue putting money in every check. So when you get your paycheck, that contribution has already been made. You don't even see that money. You won't even miss it. You get your check. Okay, you're good to go. The contribution has been made. So it's really behind the scenes, and you can start seeing the development of the growth of the money. Then we have a Roth IRA. The Roth IRA would be after-tax money, okay? And the idea here is it's money that's already been taxed. And some folks say, well, I'd rather pay my taxes now because taxes are going up, and I think taxes are going to be a lot higher later on. So when you put money in here, after-tax money, post-tax money, it grows tax-free. So down the road, when you start taking it out, you don't pay tax on that. It's tax-free withdrawals when you retire. Down below that, we have a SEP IRA. The SEP IRA is a self-employed pension. This would be for self-employed individuals. So if you have your own business, these are great because you can put up to 25% of your income into the SEP IRA. So example, if somebody's making $100,000 a year, they can put in $25,000 into the SEP IRA. So it's a big contribution amount. If you're making more than that, you can put in 25%. The max is around $66,000, so it's a big number. Also, this brings your income down. Same thing. Again, if you're making $100,000, you put in 25%, 25,000. You only report that you made 75,000 on your gross income. So it brings your income down, hopefully your federal tax bracket down, your state tax. And again, a good way to put a good portion amount away towards your retirement. Solo 1K, Solo 401 is similar. That's for small business owners, and the simple IRA as well for small business owners that want to contribute for themselves, for the business owner, and also for their employees. Okay. Down below that, we have permanent life insurance. Permanent life insurance, of course, just like it says, is a life insurance that'll be in place for the rest of your life, okay? It'll be as long as you live. Typically, you run life insurance till you're 101 years old. And when you set a permanent life insurance policy in place, the premiums are fixed. So if you're looking at life insurance, the sooner you get it in place, the better, because every year, as you get older, the premium is going to be about 3% higher every year you wait. So once you lock it in, you got to do a medical, make sure you have no issues, medically. But once you get that in place, it's set. The monthly payment or annual payment is fixed. It won't go up. And the permanent policies also build cash value. So you'll see on your statements that cash accumulation will be in there. And that money is available to you if you ever should need it. So it's good to know you have cash value build up. Down the road, when you're older, let's say, hey, my kids are grown, house is paid off, I don't really need life insurance. You can surrender the policy and take that cash value out. So you can get a loan against it, you can surrender it and get that cash back that you paid in. So that's a nice benefit. There is also term life insurance. Term is a lot cheaper, but it's for a certain period of time, right? 10 years, 20 years, 30 years. It is more affordable, but it would be like something to cover like a mortgage. Let's say I got 20 years or 30 years on my mortgage. I want to make sure if something happens to me, my mortgage is paid off, right? So you can get it for $250,000, $500,000, whatever, $1 million. But the one thing with that, if it's for other purposes, you might outlive it, right? Let's say it's just for an emergency, right? Something happens to me, I get sick, I pass away. If it's a 20-year term and something happens to you in the 21st year, you're out of luck, right? There's no more life. That term is over. And if you think of renewing it at that point, it's going to be 3, 4, 5 times as much as you were paying. So it would never make sense to get it renewed on a term. So again, and that doesn't build cash value either. So it's a affordable policy, but you could outlive it. And right when you might need it the most, right? When we get older, 60s, 70s, 80 years old, your term might be done. And then you have no life insurance. So something to be aware of when you're looking at insurance. Then we have annuities. Annuities are tax-deferred investments. There's various annuities, real popular these days. There's investments in annuities that give you, let's say, growth, like you do in 401ks and 457s, where you have mutual funds in the S&P or the NASDAQ, and you have protection on your investment. You might have 10% protection, 20, 50, 100%. So it's a way to, the annuities give you protection of your money while you're growing it. And there's also fixed annuities that give you a fixed rate, 5%, 5.5%. And these are all tax deferred. So as you're making interest on these or the growth is compounding, you're not getting taxed on it. So if you're getting growth or an interest, you defer the taxes until you take it out of the annuity. And there's annuities out there that go 3 years, 5 years, 7 years. So these are, again, something to look at if you want to get some protection. And they have no fees as well. They're real popular these days, and they're linked to the indexes, S&P, NASDAQ, and such. That'd be how basically how annuities work and how a lot of members would use those and say, hey, I want to continue growing, but I can't risk it. I want to put some protection on my money as well. Okay. Next, we're going to jump to the next slide here. Building net worth. Building net worth, of course, and how much we need to save for retirement, right? We want to go back again to determine how much we need, how much we're spending, and off your current income, right? So we start building net worth again to the basics. How much you're taking in, how much you're spending, how much you're putting aside, right? Every paycheck. And apart from the 401k or your 457, you might put money aside just on a regular account you can access, right? It might be a savings, might be a CD, might be a bond, right? Rates are really good right now. You know, the treasuries are paying over 5, 5.25, 5.5. CDs are paying great rates. So it's a good time, hey, for your money outside the IRA that you can access should be needed as well. And it's going to be non-retirement, but still part of your building your net worth, right? Then you start saving that money, buying a home, that builds your net worth. You start acquiring to pay your cars off. You know, you get assets, right? Building net worth from the ground up, from not only your retirement accounts, your savings, CDs, and your assets, right? Cars, etc. You know, all the things you might be acquiring through your life. The next slide we're going to jump to here, navigating the stormy seas, of course. So this is going to be some of the headwinds that we face when we're investing, right? There's a lot of headwinds. The market goes up, down. First one is inflation, right? Inflation, of course, again, we're hearing about a lot of inflation lately. We're paying more for everything, right? Gas is more expensive, groceries are more expensive, and inflation is through the roof, right? The Fed's been raising rates, trying to control inflation, but it's a time right now when rates are going up and inflation is very strong. So that'll come back to a normal in time. Then we're going to have political events, another headwind. That would be things unforeseen, like currently Russia could be a political event, right? What happened recently in Israel, political events, right? Let's say, hey, what if China invades Taiwan, right? What's going to happen? Are we going to go help them out? These are political events that could, you know, put a damper on the markets. It could create some uncertainty. And then fiscal policy, right? What the government's doing to the fiscal and monetary system, you know, raising rates, lowering rates, all these things are going to affect the market. But historically, okay, looking back, no matter what the issue is, the market still seems to come back, and that's why the S&P averages about 11% a year historically. So it's riding out the events and just kind of sticking with the plan and knowing that, hey, things are going to pay off. But these are going to be some of the headwinds that we'll always face along the time when we're investing. Next slide here, also again on the stormy seas. It says here, cash has barely kept up with inflation over the past 36 years, and that's so true. Because cash hardly grows, right? But inflation is up 209% in the last 36 years, which seems kind of high. But when we compare that to the Dow Jones is up 1,287%, just under 1,300%, okay, in 36 years. The S&P 500, 1,600%. So a lot of growth there, okay, compared with inflation. Even though inflation is strong, the market still outperforms. And the Dow Jones, by the way, is only a basket of 30 stocks. The S&P 500 is the true index for the U.S. markets. It's the 500 largest companies in the U.S. And that's really the benchmark. When you hear, hey, the market's up or down, it's the S&P that you're comparing growth to, okay? So like this year, the S&P was up about 18 through June, July. We gave a little back. We're still up about 16%. So again, that's going to be the S&P 500 when you hear about the market and they're comparing returns to. The next slide we're going to jump into is the Federal Reserve. Of course, the Federal Reserve, what's the Federal Reserve, right? Federal Reserve is really the central bank of the United States, right? The Federal Reserve, they control the monetary policy. Basically, they come out and they control the amount of currency that's floating around, okay, in the economic ecosystem. So the Federal Reserve, they have two goals. They want to control unemployment and inflation, right? So what they do to control that, they have a couple tools, but they'll raise rates, right? When we're having strong inflation, they're going to raise rates because what happened recently, you know, when we were in a low interest rate environment years ago, several years back, rates were very low. So when rates were low, people were, you know, it was easy to borrow. It didn't pay much to save. So people weren't saving as much. Hey, it was easy to get credit. People getting mortgage loans very low at 3% or so. You take maybe cash out, you get credit at a low rate. So people are borrowing a lot. And then people start spending a lot. So a lot of folks were spending, and driving up inflation. The economy is strong, rates are going up. So now the Fed has been raising rates, right, for the last 18 plus meetings, quarter point. So he's raised the rates a lot. The Fed ideal is trying to slow inflation down, try to slow the economy down so people stop spending. So we're getting close to there. The Fed didn't raise rates last week, but rates are still moving up on their own. Last week we had the 10-year Treasury at 4.7, 4.8. So the thought is the 10-year Treasury might even break 5%. So rates are moving up even without the Fed raising rates at the last meeting. But basically that's what the Fed will do. He'll try to raise rates or lower rates to control the economy and keep things at a normal level, right? And again, how do the rate hikes slow inflation? By making things more expensive. Rates are going up, and what they're doing, they raise the federal funds rate. The federal funds rate is what banks charge each other to loan money. So if the Fed raises rates on the banks on the federal funds rate, the banks pass it on to the clients, right? So they're gonna charge you more for a mortgage, right? But we're seeing mortgages at 6-7% right now. Credit cards, you're probably double digits, deep into double digits. So it's getting more and more expensive to borrow. And the Fed is raising rates with the attempts to kind of slow inflation down, slow down the spending. So that's why they would raise or lower rates throughout time. Okay, now we're going to discuss expenses in retirement. And expenses in retirement start early on, not just in retirement, right? So basically we have bills such as mortgages, right? Early on, it might be rent, but as we get into retirement, mortgage, utilities, maybe car payments, car insurance, regular life insurance maybe, and taxes, right? We're always going to have taxes. Apart from these, we're going to have maybe some dependents. Maybe we have kids, our own children, maybe our grandkids. So yeah, these are expenses we want to plan for as well. Maybe they're going to need help, right, with some education, some other expenses that come up. Maybe your kids, your dependents want to buy a home. Some folks, hey, I have money saved up. I want to help my kids, buy their first home. Maybe help them with a down payment or part of it, right? And help, when you have kids, of course, you want to kind of make sure that they're establishing themselves correctly. You want to be able to support them, right? Then we have hobbies, right? Hobbies can be a variety of things. Travel is obviously very popular. Some members might take, 1, 2, 3 trips a year. When we're traveling, that can add up as well, right? Especially lately, right? Taking a trip could be $5,000, $10,000, depending where you're going. So these are going to be expenses we want to plan for and have that budget. Okay, and as we look forward to our retirement, how much should we need for retirement? What's that bucket? 10,000, 20, 30,000 a year, right? Then other hobbies we might have, cars, right? Some folks like to have some older cars, some antique cars, maybe some sports cars, maybe a boat, right? Some folks like to go out boating. And other interests you might have, right? Could be collectibles, whatever that might be. You want to have different hobbies, and you want to be able to have money in retirement set aside and plan ahead for these kind of expenses and hobbies. Then we have healthcare, of course. Healthcare, we might have premiums that have to pay, maybe some out-of-pocket expenses for medical expenses that maybe we're not fully covered. And then long-term care. Long-term care can get pretty pricey, right? So if you go into long-term care, let's say temporarily or maybe longer term, that typically could be about $5,000, $6,000 a month. So that's something you want to think about. Should you need some long-term care as we get older? Maybe you want to have something in place. There are some long-term care policies, and also some of the annuities I discussed before do have long-term care built in that you can access. So you want to make sure you have something in place. As you get older, maybe you need assisted living, etc. A lot of wealth has been wiped out by not having a plan in place for long-term care. Because if you're paying, again, $5,000, $6,000 average per month, and you're in long-term care for a year or whatever it might be, it's going to really put a dent into your savings, right? All the money you save so hard to build up. You want to make sure you have something maybe and look at that, what that could look like, okay? And we can look at all these scenarios specifically for every individual, what might be, a scenario that you want to prepare for. Okay, now we're going to go into income in retirement. What your sources of income are going to be in retirement and how they're taxed. So the first one here is going to be your pension, okay? Your pension, of course, is going to be a steady income amount per month typically, and this is taxed normal taxes, right? Federal and state tax, okay? Depending on the state where you live, you may not have state tax, right? So that's a benefit. Here in California, our state tax is about 9.3%, right? We're right behind New York. We pay a lot of state tax. So when you look at federal, state, you could be at the 40 plus 40 something tax bracket, depending on your income. And these are all, we could look at these specifically depending on how much you're making If you're a dual household, you know, it's going to be more income, and there's certain brackets depending. You might be at 22% federal, maybe 24, maybe higher, right? Maybe lower. So that'd be on your pension. On the next bucket is Social Security. If your sole income is only Social Security, you don't have anything else, you may not have to pay taxes. So I believe the number is around 25,000 or less. If that's your sole income, Social Security, you may not pay taxes at all. That would be more a question for your tax advisor. But if you have Social Security and you have other sorts of income as well, like a pension or you have rental income, et cetera, for properties, you're probably going to get taxed on that as well. So again, everyone's going to be different specifically on your overall income, even though Social Security is going to be part of it. We want to look at that as well and see what the end result is. And maybe if you're at a certain threshold, we might say, hey, why don't you scale this back? Take a little bit less out of your pension, so you don't go into the next higher tax bracket, and maybe avoid paying taxes all, right, in a whole. Next, number 3, we have retirement accounts. Deferred comp, right, drop, 457, all the 401ks we discussed earlier. All these accounts that we set up here are all pre-tax, right? So you put money in pre-tax, it's growing tax deferred. But same thing, as you start taking money out of these, ideally on a monthly basis to supplement your income, you got to pay federal and state tax, okay, as you take the money out. So typically on these plans, you want to take it out a little bit at a time to supplement your income, you know, to make sure you have enough to last as well. You don't want to take too much out at once because you're going to have a big tax bill the following year, right? The more you take out, you're going to owe more taxes, and you're going to the Fed's going to, the IRS going to come looking for their money. The last column, we have savings, right, and equity, CDs, bank accounts, rental income. Again, these are all taxed as ordinary income. Okay, normal income as well. If you're in a CD, you got to pay federal and state tax. If you're in a savings account at a lower rate, you also got to pay taxes on that, federal and state. Even though it's a low rate, it might be a checking savings, that's going to be taxed as ordinary income. If you do treasuries, by the way, U.S. treasuries have no state tax, so that's a benefit. I do a lot of treasuries with members. You got to pay federal, but at least you don't pay state tax. That's a benefit. Then you have life insurance. Life insurance is tax-free. So God forbid something happens to someone that, you know, you get an inheritance of a life insurance, that lump payment is tax-free on the life insurance, okay? So that's some basics again. We can always go into specifics, you know, scenarios, et cetera, with each member on a one-on-one basis, but that's a good overview of income in retirement. On the next slide we're going to go into here is pay attention to order. Same thing again, very similar. Pay attention to order, how your money is coming in, how much money you're getting. If you got Social Security coming in, again, we may not be paying taxes on that. If it's a small amount, it goes off your overall gross income for the year. Your Social Security is one bucket coming in. If you have other income on top of that, again, you might have to pay tax. So you want, maybe if you can defer some of it, we can look at those numbers and see where you're at. Pension income, as we discussed, tax is ordinary income, right? Pension is going to be taxed. Same as IRA, 401k, ordinary income as well, federal, state, right, taxes. Dividend income, this would be from stocks, right? Stocks that pay dividends. The stocks that pay dividends are going to be some of your solid blue chip stocks, like the value stocks. They'll pay dividends anywhere from 3, 4, 5% a year, and they're qualified dividends, so they're taxed at a favorable rate, 15% to as high as 23.8. Average is about 20, but again, 15 to 23 average dividend income, and that's it. When you have long-term capital gains, okay, something you held for longer than a year, you're going to have similar tax rates, 15 to 23%. You might be on the lower end, you might be in the middle. Everyone's going to be different depending on what your write-offs are, et cetera. So long-term gains, 15 to 23.8%. And liquidation of investment principal, there's no tax, because this would be basically, let's say you put money into an investment and it gave you interest or it gave you growth. The gains are taxable, right? But the return of your initial investment, you're just getting your money back. So you don't get taxed on your principal that you put in, right? Only on the gains. So again, the principal, tax-free, the gains or interest, it'll be taxed depending on how you take it out. If it's long-term gains in growth, 15 to 23.8. If it's interest, ordinary income, you know, on your per year, it'll be taxed at your ordinary tax rate if it's paying off that year, federal and state tax on any interest you make, okay? Next we're going to jump to is choosing the right withdrawal rate. So this is going to be a little bit debatable. It used to typically be about 5%, right? If you have, let's say, $500,000, you're taking out 5% a year, $25,000 a year, paid monthly. That's great. So you want to establish a somewhat conservative withdrawal rate for, so it's going to last you longer, of course, and it can be adjusted, right? 3% now is more of a standard for some folks, 3% versus 5%. It's a little bit debatable. And these, we can run scenarios. You say, okay, Patrick, I have this amount of money. I'm investing in this kind of portfolio. It's averaging a return of 11, 12%. When I start taking money out, let's say I have 500, 800, $1 million, what will it look like if I stay invested? I'm taking out the dividends, right? 3% a year. How about 4%? And then we can run scenarios at 5%. So you can see, okay, over the next 10, 20, 30 years, you've taken out this much of income off interest or dividends, okay? And your principal is here. So you can see, okay, your principal might still be at a higher value. So ideally, you want to be able to live off that interest, right? The dividends and interest, but still have your money working. So it's still growing, maybe in a balanced portfolio or maybe, in a growth portfolio. And we can do projections and look back. Had you done this 10, 20, 30 years ago, what the result would be. So we get to kind of gauge how the money will likely perform going forward. And then we can adjust it, right? And tweak the numbers to see, okay, this is where I want to be. And then we can always adjust it along the way as well. If you said it, hey, I'm taking out 4%, I need less, we can adjust it so it's not set in stone, okay? And then the last option there, is going back to work, which, ideally, if we save early enough in life, we shouldn't really have to go back to work unless you want to do a part-time job just to stay busy, right? That's totally different. If we build up a nice amount of money, we should be able to live off the interest, have the money growing. And that's ideal, right? Ideally, you don't want to just take the bulk of money in retirement and start living off of it and just, right, living off the principal and bringing it down, down, down. In the perfectly scenario, you want to live off the interest, and that asset will be there for your heirs, for your family. You pass it on. So that's ideally how you want to do the withdrawal rates. Next slide we're going to jump to is Money Guide Pro. Money Guide Pro is a financial planning software we use it's based off goals, goal-based planning. So on this, it's a very elaborate software. We put in all your information, your age, how much you're making, how much you're contributing to your retirement accounts, to your 401ks, 457s, and then what your target retirement age is, okay? So it runs numerous Monte Carlo scenarios to see, okay, what the likelihood of success is, okay? And it tells you, I want to retire at this age. I want to have these goals. I want to have a second home. I want to buy a boat, right? All the goals get built into the model. And then it shoots out the likelihood of success. In this illustration, it's an 82% probability of success, which is pretty good. So ideally, you want to be up in that green zone. So then we can plan ahead for when you're going to retire. Your score might come back at 55, 60%. So you say, hey, how can we increase this probability score? Maybe you got to add more in, right? Maybe you're putting in 4 or 5% into your retirement account. Maybe you want to kick that up to 8. How would that look, right? Maybe you're in a balanced portfolio. You want to add a little bit more equity, right? So we can tweak all the numbers, and maybe you want to kick the retirement age down a couple of years, a little later. But it really comes down to how much you're putting in. The compounding effect of money, again, it's going to do a lot as it grows forward. If you're probably putting in 3, 4%, it's probably very low. 5, 10, 15%. A little more realistic to help you get to that goal. And we don't think too much about retirement, right? When we're young, 20, 25, 30, 35, we really don't think about it, but that's when you want to start, because you're not seeing that money, and the next thing you know, hey, I have 6 figures here built up. I'm glad I started this, and I've been contributing, right? Constantly contributing every paycheck. And then we're going to have a nice retirement fund there as we get closer and into retirement. That's the idea. So the Money Guide Pro, it's a service we can run for anyone to do intensive planning and see what's retirement going to look like. When can I retire? Can I retire at this age, 58? Maybe it's 60, maybe 65. So these are things we can definitely help you plan as we go into and closer to retirement, even and early on, from the get-go. Next slide we're going to jump into is drop best practices. When to enter drop, right? Should you go for a higher pension? Okay, so drop, of course, is an extension of your 457. You're fortunate to have drop, right? Because when you go into drop, let's say you're going to retire and you can go 5 more years. So your pension is paid into a drop account. So they're putting that pension money into drop. So it's all the tax deferred, it's going into the drop. And typically you'll say 5 years, and you might have, a light duty job, right? While you're in drop. And I've seen the average drop account, over the 5 year, it'll grow like 500,000, right? It's pretty good average. And when you retire after the 5 years, right? That's when you go for the higher pension. You wait for that 5 years. Some folks might say, I'm going to do 2.5 years or 3. Some folks don't want to do drop at all. They just, hey, they're done. They just want to go, right? They want to maybe start traveling, right? Enjoy their life. So these are calculations we can run for everyone specifically and say, what's my number going to look like? What will I get now if I don't do any drop? What if I do 2 years or 1 year drop? Or what if I do the full 5 years? We can get projections. And if you do the drop 5 years, then you start getting your pension paid to you, right? Your pension's going to pay to you every month. And then you're going to have the drop bucket as well. So let's say you're getting your pension every month. You're going to get taxed on that. Then from the drop amount, maybe you have enough with your pension to pay your bills. And the drop money, maybe you want to try to grow that for legacy planning or grow it for yourself. Or maybe you want to get some extra income off of that, right? So if you have a certain amount and we can generate 3, 4, 5, maybe 6% interest on that, it's going to help get you more income on a monthly basis. But everyone's going to be different and what you may want to do with the drop money. And again, that ties back to how many years you stay, depending on on your circumstance, right? I think 5 years is pretty nice to have that feature available. It's something that many don't have, right? Creating that extra drop bucket for you there. What do I do with drop funds when you leave? Typically, most would roll it over. Not only drop, but if you have a 401k, 403b, and drop, when you leave, you want to roll it over to an IRA. There are a couple of reasons. First of all, if you have a 401k or a drop, you have mutual funds typically in 401ks. Okay, you're investing in mutual funds. You want to grow that money. The S&P 500 is your large cap growth category. Then you have mid cap, small cap. But you're at the mercy of the market, right? You go up 1 year, you go down the next year, up. Okay, last year was down 18%. This year we made back 18%, right? So the market averages out. For the past 3, 5, 10 years, the market's done 10 and a half a year, 11% per year, 12% per year. So we can look at how the market's done. But when you roll over to a rollover IRA, there's no tax consequence, right? It's a direct rollover. But what that does is it opens up so many other investments that you can do with your drop money or your 401k. You can buy CDs in your IRA if you want. You can buy annuities to get growth with protection. You can buy CDs. So all these products are not available in your drop, right? They're not available in your 401k. So it's really a way to get the money growing, continue growing if you want to continue growing, how to maybe get some better income off of it, better interest rates. And it's all tax deferred. So it stays within your IRA. And then we can look at what's your objective. Do you want to grow this money? You want to get some income? All tax deferred in the IRA rollover until you start taking it out. Then you start paying taxes, right? So ideally, you want to start taking it out a little bit at a time, maybe on a monthly amount, right? To just supplement your income. And the distribution, that's what I'm talking about there, same thing. You want to take it out a little as you go. So you have the drop bucket, you have your 401k. What are your needs? What's your budget, right? How much income do you need now that you're retired, right? For maybe your mortgage, maybe your house is paid off. How much for the trips, right? The trips you want to take. So this is all just planning with the buckets you have, the drop, 401k, and definitely rollover is what most advisors, no matter where you are, would recommend. Because again, it opens up so much different investments you can do, better returns, more protection, and all tax deferred as well. And we can look at every scenario, specifically with each member. We can even call, the drop helplines and ask any questions that may come up if we don't know them here. But we've seen a lot of these. We know the paperwork. We're very familiar, and we can definitely help as you approach drop and as you go into drop and see what the best option is going to be for you. Okay, next, I think we're going to jump to, that's going to be questions and answers. So
we got questions.
We have some time here for questions. We'll field some questions. We can ask them now. You can call me individually. My contact information is on the screen, and see if we can help you out and just spark some interest on help you start planning accordingly as we go forward.
Perfect. Thanks, Patrick. So if any of you think of any questions while Patrick's answering these, feel free to type them into the Q&A below, and we'll definitely get to them. So the first question is, if you do not have deferred comp, where should you roll your drop money?
Deferred comp. Well, your drop money, you want to roll it to an IRA, an individual retirement account. So your drop money, your 401ks, all this money that's tax deferred, yeah, you want to definitely roll it to an IRA, individual retirement account. That's a tax-free rollover, no tax consequence at all. So that's what you want to do, definitely into an IRA. And that IRA is just a shell account, right? Some people ask me, well, what's the investment in the IRA? That's just a shell account, right? The money comes in cash, it sits in cash in the IRA. Then we sit down and see, okay, then we do some planning. The money's in the IRA, It's tax deferred. Then we start planning. What's the objective of the money? You want to create an extra check every month? You want to try to grow it? How do we protect it? That's the idea. But again, it goes into an individual retirement account, IRA. Absolutely.
Perfect. All right. Next question is, when should I file for Social Security?
Typically you want to start as you can. We have to wait till you're 62, okay? But every year you wait, you're going to get more income from Social Security. So the longer you wait, the better. But ideally, minimum 62 years old. And for that, depending how many credits you built up, we can log in and we can call the Social Security Department and check on the website and see how many credits you have, how much money you'll get if you start at 62, how much more you'll get if you wait another 1, 2, 3 years. So the longer you wait, you're going to get more. But we can always typically looking at 62 is the average age for minimum.
Perfect. All right. The next question is, what is a joint IRA?
Joint IRA, good question. Okay, joint IRA, there's some products out there, like an annuity, basically. There's annuities you can say, hey, I'm going to put some of my money, maybe typically we do like 50%. I'm going to put some of my money into an annuity that's going to give me some growth. Okay, I'm going to try to grow this for another 5, 6 years, whatever. And then at one point, I'm going to turn on income. Okay, I'm going to start drawing income. And that's going to pay you income for the rest of your life. So these are pretty elaborate products where it's going to pay you income, a check every month, as long as you live. Even if that balance goes to zero, it's going to continue paying for the rest of your life. If you pass away, it'll go to your wife for the rest of her life. So that's what they refer to as a joint IRA. You take your IRA, you're getting income for life. When you pass, your wife collects the income for the rest of her life. That would be what they mean when they say a joint IRA. And these, again, are products we can look at. For all these annuities, we partner with people like our partners like Nationwide, Prudential, et cetera, right? These are all, big life insurance companies that kind of protect your money. That's what you're doing on these products.
Perfect. Thank you. Well, the next question is, what is a Roth conversion?
Oh, good question. Okay, Roth conversion. A Roth conversion is when you take your IRA, the money you've been putting in for years into an IRA tax deferred, and you roll it over into a Roth at once. You convert it. So the idea, folks have done this, these were popular years ago. Someone takes the whole amount of their IRA and they roll it, they pay the taxes that year. The folks that do that, they think, hey, you know what? I'd rather pay my taxes now, my federal and state, because I know that taxes are only going to go up. And if I wait and I start taking money out in 10, 20 years out of my regular IRA and pay taxes later, I'm probably going to pay more taxes later. So the Roth conversion, you do a one-time rollover into a Roth and you pay your federal and state. Now that can be a drawback because if you end up not living in California, let's say you do that now, you're in California, later on you decide I'm going to move out of California and you leave, and then you've done the Roth conversion and you paid state tax, which you really didn't need to do if you're living out of state, right? So that's something to be aware of. If you think you're not going to live in California, for the Roth in general, if you're thinking of a Roth, it's important. I say, ask members, do you think you're going to live in California? I say, no, I'm going to move out of state, maybe to a state that has lower taxes, right? State taxes, or maybe a friendlier state tax, Texas, Nevada. So that's something to be aware of on the conversion or the Roth overall. If you're not going to live here, you want to think about that twice. But it's a big tax bill. If you convert it now, you will pay taxes the following year, federal and state. So then that's once. Then you never pay taxes again on that money once it's in the Roth.
All right. The next question is, how much should I contribute to my IRA and when is the deadline?
Yes. Good question. Okay, so that just recently went up. It used to be 6,000. For this year, it's 6,500, 6,500. And that's kind of a low number, I think, but it's the max you can contribute and write off. Okay, you can write that off. So the deadline is April 15th. This year we got an extension, right, which just passed in October. But typically April's the deadline, 15th, and the contribution amount that you can write off, 6,500 is the amount. That's for the IRA. Again, the 401ks, 457s, 22,500. So that's a bigger amount. And again, a SEP IRA, self-employed pension, 25% of your income, or 66,000, whichever's the lower. So those are big numbers to keep in mind as well. And on the IRA, you want to try to put that 6,500 a year. That's really small. So you want to definitely max that out every year.
All right, so we have a question. Can we briefly put up the previous slide about tax rates? So let me go back to that real quick.
This one or the previous one?
No, this one, yeah, right here. They sent that a while ago, yeah.
Yes.
All right. Perfect. All right, and then While they look at that, there's another question. I thought money withdrawn after 59 and a half years old was from a Roth IRA or Roth 403B was not taxed.
After, wait, from a Roth IRA? From a
Yes,
Roth IRA?
so a Roth IRA or a Roth 403B.
Yes. Yeah, there's no tax on the Roth, okay? And the 59 and a half you're referring to, that's the penalty. So if you, by the way, if you take money out of any retirement plan, IRA, 401k, there's a 10% penalty if you're not 59 and a half. The Roth, there's no taxes, okay? Because you paid that tax already when you went into the Roth. So the Roth money, the contributions to the Roth is after tax money. So two things, when you take the money out of the Roth, there's no taxes, okay? If you're 59 and a half or younger, there's a 10% penalty, okay? Also on the 10% penalty, something to be aware of, on the 457s, okay, the deferred comp, the 457s do not have that 10% penalty. So if you take money out of 457 and you're not 59 and a half yet, there's no 10% penalty. So that's a benefit for those that have the 457 retirement account. There's no 10% penalty if you're under 59 and a half. But the other accounts, there is. If you're not 59 and a half, you're gonna have a 10% penalty. Once you're over 59 and a half, you're good on that. Another thing that comes to mind, a lot of these plans, the 401ks, 457s, when you get to a certain age, typically about 59 and a half, you can do an in-service withdrawal. An in-service withdrawal is good to know. That means you're still working there, but you can take money out of your 401k and you can put it to an IRA before you retire. The benefit there is, again, by taking it out through the in-service withdrawal, you can put to an IRA, and in the IRA, you can start protecting the money. You can still try to grow it, but add some protection on it. Hey, Patrick, I want 10%, 20, 50% protection on my money. I want to try to grow it, but let's put a layer of protection on it, right? Or maybe you say, hey, I have enough. I want to just get something that's going to give me an interest payment, CDs, etc. So again, some basics around that 59 and a half age, right? Typically a 10% penalty if you take money out of a retirement plan, not the 457. And again, in-service withdrawal is a feature that most of these plans allow you to do as well. So something we can explore as well to help protect money.
All right, so next question, is there a minimum age when you can withdraw from an IRA?
Well, yeah, from an IRA, you can withdraw, but again, keep in mind, when you take money out of an IRA, you're going to pay federal and state tax. Okay, it'll be part of your ordinary income that year. Plus, if you're not 59 and a half, you're going to have a 10% penalty on top of it. Okay, now there is a loophole where if you take money out of an IRA and you put it back, you have 60 days to put it back. So let's say something comes up, I got an emergency, I'm going to take this money out of this IRA. That's the only money I have. If you put it back within 60 days, you're good. So there is a loophole. You can take it out, 60 days, put it back in, or whatever you can, and then there's no tax. So then you're covered. So that would be something to be aware of as well. And these are more, a little more tax questions. But yeah, that's something you could look at. But if you take it out prior, 59 and a half, 10% penalty, and again, part of your ordinary income, federal and state tax. That year you take it out. So if it's a big lump sum, right? 20, 50, 60, 100 grand, you're going to have about half of it's going to be gone on taxes. So somebody say, hey, I have an emergency. I'm going to take out, I need $50,000. I'm going to take this out of my IRA. When you figure your taxes, you're only going to have about half that money available. I mean, you'll have it there. If you don't withhold taxes, you're going to have the tax bill next year, half the money you took out, right? Including the 10% penalty if you're under 59 and a half.
All right. So next question, at what age should you start or must you start in RMD?
Ooh, RMD, yeah, 77. I think what's 72 and a half, I believe now. It used to be 70 and a half. I believe it's now 72 and a half. So RMD, 72 and a half. You start taking that money out. It's a very minimum amount. It's off a calculation of the account value from the previous year, but definitely that's something you got to be aware of. And you'll get notifications when that time's come as well. It's gone up. It used to be 70 and a half. I think it was 71. Now I think it's 72. I got to look at my cheat sheet for that one, but yeah, I think it's 72 and a half.
Right. And is there a difference between a 457B, I'm guessing, rollover versus IRA? What's the difference between those two?
457, which one?
A 457 rollover versus an IRA.
Yeah, the 457, I mean, that's a tax deferred account. The 457 is similar to a 401k or a 403b. So typically, I mean, the rollover, you roll over from these plans, 457 into an IRA. You roll it from there into an individual retirement account. So that's where you roll money into. If you have an individual retirement account and that's your sole retirement account, that's that's your retirement account. So typically the 457 ends up ideally in an IRA, in an individual retirement account. Some folks that don't have a 457 or a 401k or a 403b, they got to do IRA, individual retirement account. That's their sole retirement account. That's what they have. But again, the 457, you roll it into the IRA, either when you retire or through an in-service withdrawal. If you're at a certain age, you can do that ahead of time.
Perfect. All right. If you have had term life insurance for many years, how do you get started with permanent or whole life insurance, and which is
Yeah.
better?
Yeah, if you have term, okay, I mean, it's set in place, that's going to lapse. I mean, here's the thing, if you have term and it's going to come up, to do a permanent, I think is a good way to look at things, because that's going to be in place for life. If the term was put in place for a specific need, like your mortgage, and okay, that's going to be there for your mortgage. When your mortgage is covered, when it's paid off, that term's over, that insurance is gone. But again, like I mentioned before, the risk is you won't have insurance beyond that. So all the premiums you paid in, that's just money gone, right? It's kind of like paying any insurance. You're paying in the permanent, we'd run an illustration, say, how much do you want for a death benefit, right? Should you pass away, do you want $250,000, half a mil, a mil? And then we see this is how much your premium would be. So it's all adjustable, right? Customizable. You say, okay, or you can say, hey, what's your ideal budget? How much do you want to spend a month on your permanent policy? You want to spend 100 a month, 150, 200? So we can work the numbers backwards, or we can say, okay, I need this amount of death benefit, $500,000. And then you have either a flat death benefit or one that grows. So you might start off with 300,000, it's going to grow over years, as will your cash value. So when you do an illustration on the permanent policy, it shows you all the years till you're 110, whatever, 101. Some might say, I'm good till 100 years old. Just run till I'm 100. And you'll see how much the premiums are, how much the death benefit is growing. And you can say, okay, when I'm 85 years old, my death benefit will be this amount, my cash value will be this, and your payment is always fixed. It will never go up from when you sign up. So once you get that policy in place, you're set. You know exactly how much your premium is per month or per year, and that's it. It won't change. So again, that's the thing to do. If you're going to do that, the sooner the better, because as we get older, you're going to pay more every time if you set it up later in life.
All right. Next question. Can you roll over drop money to both deferred comp and IRA, or an IRA?
Drop money to deferred comp. No, well, typically it's the other way around. Your deferred comp is part of your, like for the deferred comp goes into the drop account. Give me that question again.
Can you roll over drop money to both deferred comp and an IRA?
No, you only to an IRA, only to an IRA. So you want to roll the drop money into an IRA. That's ideally where you want to go, into an individual retirement account.
All right. And then next question from the same person. Can you roll over accrued leave payout when you exit drop? And can you put both into a deferred, or can you put both into an IRA?
I have to check on that. I'm not sure. I think maybe not, but I have to check. I have to get back to you on that one. You can reach out to me specifically, individually on that one, because that's going to be a more complex question. I have to check with the drop. I think maybe not, but I want to make sure. I don't want to give you I don't have the right answer for that one right now. I can find out though.
All right. Next question. What are the rules for RMDs when you inherit a Roth IRA and 401k?
Yep. So you have to take money out. RMDs, same thing. You have to take an inherited IRA or a Benny IRA, Benny IRA. You got to take money out every year from that IRA as well. And there's a calculation. So it goes off the age of the person and the account value. So when you come to the RMD age, you're going to take out from your own IRA and from the inherited IRA both. So you'll have to do both of those along the way every year.
Perfect. All right. Next question. Are you a fiduciary?
Absolutely. I am fiduciary. I put my client's interest first, always. Absolutely so.
All right. So here we got a longer one here. So our 32-year-old has about $100,000 total in savings and is self-employed.
Ooh.
House prices are in California and interest rates are now out of reach for her. The money is in CDs. Where should she invest the money? She does not have a 401k or 457.
Well, first of all, if she's self-employed, I mean, if she doesn't have a SEP IRA, a self-employed pension, right, that'd be the first thing I'd set up. And confirming, again, you can reach out to me to make sure I understood correctly. If she's self-employed, putting 25% of her income right away, right? So if she's making whatever amount per year, if she can, put 25%, and that's going to be money for long-term to retirement, right? She's going to put that money in. She shouldn't touch it till she's into retirement. So that's a big benefit. So you put in 25%. So if whatever amount she's making, if she puts in 25%, that'll be a contribution. And then once it's in the IRA, she can invest it depending how she wants to. For a better interest rate, ideally for her age, she probably wants to grow it. So you want to maybe try to grow it in the market, maybe with some protection on it, so you don't take any down years, so you get some protection. Try to grow it. That'd be one place. And also, right now, while rates are good, maybe locking in some of the other money that she might need shorter term, right, on the CD. We have some shorter term CDs here at the credit union can do. Again, rates are 4, 5, 5.5%. And these rates, sorry to say, they probably won't last for too long, right? A year from now, we may not even have 5. So there's a point when the Fed is going to stop raising rates, and then he's going to start cutting rates. So it's a good time for folks that like to save, that like to get 5% or 5.5%, and say, hey, why don't we lock this in for 1 year, 2 year, 3, 4, depending. And again, if you don't need the money, you want to keep it safe, it's protected, you're getting good interest. But for that individual, we want to sit down at least in person or on the phone and make sure what her liquid assets are, what she needs, right? For the emergency fund first, how much she needs for operating. And if she's self-employed, the SEP IRA, self-employed pension, I think would be a great start for her. And then it's a matter of, hey, how do you want to try to grow it, or you just want to try to get an interest payment? Typically at that age, to build money into retirement, you got to go into the market. The market averages about 11% historically. So it's going to be a lot more compounding, a lot better growth to build those assets into retirement for later years. And we can run projections on that. How will this look in 5, 10, 20, 30 years? What's my balance likely to be, right? So we can do all those and help folks learn and understand what all the solutions are, what the potential, investments they could do.
All right, last 2 questions. I have deferred comp. Is it ideal to contribute 50% to post and 50% to pre-tax? Is there a scenario where one or the other is better?
Yeah, well, that ties back to, again, if you're thinking of leaving California, that would be the first thing to consider, right? If you're doing post-tax, you're going to pay tax, right, in California. So we can run illustrations and see what the best result is for your particular situation. But typically, if you're going to be in California, yeah, I mean, that's not bad, because you can have that post-tax money will grow tax-free. So when you take that out, that's already tax-free growth. You paid the taxes once. And the other bucket, tax deferred, that'll be something you'll draw out, down the road and pay taxes at that point. Taxes may be higher. So yeah, those are both good strategies, but we'd want to look at both and kind of run the numbers and see what the best net result is and what your tax brackets are going to be as well.
All right, and then last question of the night. What are your financial planning fees?
There's no financial planning fees. Okay, the Money Guide Pro that I showed earlier, that's a free software. It's a very elaborate. That's a courtesy for our members. We run those all the time. And for me, there's no ongoing fee. Here, we have a couple platforms. We have standard brokerage. So somebody says, hey, I just want to buy a CD or a treasury. It's really, that's a standard brokerage. If somebody comes to me and says, hey, Patrick, I have this account at XYZ firm. They bring the statement in. They have mutual fund stocks. We have both platforms. We have a fee-based platform. We have non-fee based. So it depends on how much activity you want. So again, somebody comes in and says, I have a bunch of stocks. I want to buy stocks. I want to buy mutual funds. I'm going to trade. We can hire an institutional manager to run your account. And a lot of firms these days, Merrill Lynch, et cetera, Fisher, they charge 1% a year. We have that platform, but typically most members, I just start off with a standard brokerage. There's no ongoing fee. I don't charge them. So we buy a CD. There's no charge for those. We buy a T-bill, very minimal, $50. So again, it depends on what type of account you want. If we do annuities and such, no fee. Standard brokerage, no fee, principal protected. So it's really, we have all the choices available. We have all the tools, technology, of course, experience. So for the majority of clients, it's just a standard brokerage, unless they have a lot going on, a lot of stocks, mutual funds, they want to rebalance. And then on that note, when we look at the S&P 500, okay, up about 18% for the year. Technology, NASDAQ is up about 30%, 35%. So if somebody says, hey, the S&P is a benchmark, there are money managers that are up 25, 30% on growth. So if you want to have better growth, et cetera, we can look at different platforms to see what the best might be for you. But it's very, very flexible.
All right, thank you, Patrick. So that's going to conclude tonight's webinar. Just thank you again for Patrick for giving us all this really insightful information. Just as a reminder, you will be receiving a recording very soon, so just keep an eye out for that. Patrick's information is up on screen, but also when you get that recording, you'll be able to see this information. You can reach out to him directly if you have any other questions about any investing options for you. If you do have If you do have any questions about any liquid accounts, such as checking accounts, savings, money market, certificate of deposits, please feel free to reach out to our team, either at the branch office, our call center. We're definitely here to help you guys out. Yeah, we appreciate you joining us tonight, and we hope you have a great night.
Yeah,
Thank you
and
again.
again, last thing, I'm in the branches every day, so I go between downtown and all the branches. So if you're thinking of coming in, call me ahead of time, make sure I'm there because I might be going to another branch. You can call me, make an appointment, get some initial questions on the phone as well. We're happy to help, and we appreciate your service and glad we can get something back.
All right. Thank you, everyone. Have a great night.
Thank you. Thank you all. Good night.